Good morning, everybody. You're all very welcome. Thank you for joining us this morning. My name is Ian O'Doherty. I'm the CEO of Park Group. I've been in post now since January. Prior to that, 25 years in financial services, most recently with MB&A based up in Chester.
My name's Tim Clancy. I'm CFO. I've been with the business 3 months. Before then, 7 years in financial services with Assurant. Before that, Shop Direct, and before then, 10 years in the travel industry.
Steve Miller. I'm the Chief Information Officer. I've been with the business since June. Before that, Bank of America Merrill Lynch, Standard Chartered, JP Morgan. I've been in the industry for 20 years.
Very good. And we're also pleased to welcome our chairman, Laura Carstensen, who's joining us here this morning. What we'd like to do this morning is we want to talk through our half-year results, but then also talk about our strategy for the business. We're in an interesting situation. We've got the business is changing leadership, as demonstrated by ourselves here, plus others back at base. But along with that, changing ambitions, changing opportunities. We have a changing marketplace as well. There's a lot of competition in the marketplace for various reasons. There's an increasing expectation from customers around the digital realization of all products and services, and it applies not just to ourselves, to other markets as well. And then, online and mobile is increasingly part of everyone's experience. So the marketplace is changing. So what we have is we have a strategy that we believe positions us well to enhance our already solid position, identify new opportunities, and position the company well for a bright future. When I started meeting with folks, when I first came into the position, met with some investors, I talked about wanting to understand the business before we started making any pronouncements about things that we might change. And I said we would keep the existing strategy in place while we looked at changing, looked at what we needed to change and then applying those changes as appropriate. So I'm pleased that the results that we're talking about here today, the first 6 months, up until September, at the end of September, basically we've done exactly that. We've kept the business going. We've maintained the strategy that was in place, haven't changed anything radically, while we've been looking at what we might want to do and how we might want to change the business. And we've got some very solid results to talk to you about. Tim is going to explain, go through them in more detail, but basically we're in a position where we feel good enough, and we've increased the dividend by 5%. So it's gone up to the 105 that you see there quoted. So we're very pleased with a solid set of results that we can present to you today. Operationally, there's some highlights that I would just call out. Both corporate and consumer sides of the business have performed well. We have signed some new retailers. As you know, retailers are a cornerstone lifeblood of our business, and we've signed some new ones and increased our reach for our consumers that use our product. I would call out maybe Arcadia as an example, with a nice stable of brands that everybody would be pleased to be associated with, and we've been working on that one for quite some time. So we were pleased when we were able to announce that one. I know it was announced earlier in the year, but it was during the half year in question. So we're very pleased about that. I've mentioned that we've strengthened the management teams, but it is significant that we have been trying to build on the success of the business from the past, but wanted to increase the expertise in the business, and hopefully you'll see it demonstrated by what we're talking about today and as we go forward as a business. We have been developing the strategic plan that we're going to talk to you a little bit about. Some of the initiatives around that have already started, and so we're not just waiting to tell you before we do anything. So we've been working away on some things, and we've been seeing some good results from that work, not least in just some operational efficiencies. There were some obvious things that were easily fixed, and we've already addressed those, and we will continue to build on those as we go forward. So operationally, we're very pleased with what's been going on during the year, and it's positioning us well to build on it as we start to fully implement the strategy we'll tell you about shortly.
Okay, so we're going to go into the numbers section now. We're going to go through the numbers reasonably quickly. So slide 7, 3 themes to the overall numbers. I think firstly, they're in line with expectations. We do traditionally report a loss in the first half of the year as a consequence of our Christmas savers business. So in line with expectations. Number 2, the margin is improving. We're driving better mix of products, both in-house products and form of delivery from paper to card. And thirdly, The numbers are reported following the adoption of IFRS 15, which is a new accounting standard, which I'm going to explain in a few minutes. If you look at this slide then, segmental overview, this is split into the traditional sort of presentation of numbers. Within the corporate business, billings are ahead, and that is despite the removal of some low margin intermediary business that occurred in the prior year. Without that, billings would have been 10% ahead. Revenue down for that reason and also for the restatement of IFRS 15, but overall profits ahead because of the mix improvements. Within our consumer business, billings 9% ahead, but that is more of a timing point. We'd expect our consumer business to be broadly in line with prior year. But if you look at the last point on the far right of the slide, extended self-service, that's one of the examples of the efficiency improvements that we've been adopting, which essentially allows customers to close off their account quicker and enable them to get hold of their product faster. And that generates cost savings for us. So overall, good set of results. So if we move on to IFRS 15, I've got 2 slides on this. There is a separate document available on the website from this morning that's got 30 slides that shows, for those who are really interested in the subject, full restatements and all the nitty-gritty. In summary, just here today, you'd be pleased to know, it's a new standard that aims to provide better consistency and comparability across different businesses in different sectors. We've adopted a fully retrospective approach, which means we've restated 5 years, which we think gives a much better trending and a better read of our results over the years. I think what I would say before sort of talking through some of the aspects of it is this is an accounting change. It doesn't impact on the overall business model profitability. It doesn't impact on billings. It doesn't impact on cash flow. So it's an overall, I guess, accounting change. So, on the slide, you can see on screen, the standard requires the adopter to go through 5 steps. And without reading up through all the detail, I'll sort of highlight some of the key conclusions for Park. So the first one is that we are now treated as an agent for our in-house multi-retailer product. So what that means is we need to report revenue on a net basis. So previously for our vouchers, we reported revenue gross, which means at face value. Now we will be reporting revenue net, which means we're recording the service fee only for our vouchers. That is actually consistent with how we report for cards now, or previously to IFRS 15, but that is certainly a change which will clearly reduce revenue, but not have a significant impact on profit. I guess another sort of key aspect is this change to agent is just for our in-house product. For our third-party product, we still act as the principal. So where we buy, for example, M&S vouchers and pass them on to our customers to redeem, we'll be treating that third-party voucher as a principal and so still record that gross. So in-house products are all consistent on a net basis, but third-party vouchers will still be recorded gross. Likewise, for our products, our merchandise and our hampers, obviously we are still the principal there and we'll still record all those revenue gross. A couple of other aspects, breakage, which is our unspent balances on cards and vouchers, that will now be treated as revenue. And obviously we'll make that change. And then final point, timing, which is quite an important one as well. We will be recognising revenue on redemption going forward, not on dispatch. So in the old scheme, we would be reporting revenue of vouchers at face value when they were sent to the customer. Within the new accounting standard for vouchers, we'll be recording revenue net, which is the service fee, and at point of customer redemption, not on dispatch. And the effect that has is it pushes revenue out and defers some revenue and obviously some profit as well. So next slide, slide 10, shows hopefully a very simple summary. Split vouchers and cards. I guess good outcome from our point of view is we do have consistency across vouchers and cards now. So if you look at the top row on vouchers, revenue face value on dispatch moves to service fee on redemption. The key change for card is on breakage, where the revenue for breakage was taken previously on load, which is the penultimate row on that slide, and now we'll be taking that breakage revenue on redemption. So that will essentially come over a sort of average profile as customers redeem that product. So final point to stress, doesn't change the business model, doesn't change cash flows, nor the sort of overall profitability of the business. Okay, so I'll move on to the actual numbers. And actually just to sort of, I guess, reinforce the point I've just made, if we look at the far right-hand column, that is the restated numbers for the full financial year last year. So billings of 412. So billings are unaffected by IFRS 15, and I think actually is a really good sort of proxy for overall activity of the business because it's the face value of everything. So that's like for like. If you look at the prior year revenue, that is now restated at 111.1. Originally, pre-IFRS 15, that was reported at 296.2. So you can see on the revenue line, there is a significant change and reduction as a consequence of adopting the new accounting standard. However, if you look down a few more rows to the profit before tax, much less impact. So profit before tax restated is 12.6 for last year. The original recorded profit was 12.9. So minimal impact on reported profit in the year, only about 300k, significant impact on revenue. So in terms of the actual half year numbers, in the other two columns, billings ahead by 3%, which obviously we're pleased about, obviously unaffected by accounting changes. Revenue down as a consequence of removing some of the low margin product I talked about earlier. And then a couple of other points to make on this slide. Within central and property costs, we've incurred some strategy development and research costs. We're going to be talking about some of the outcomes from a customer research project when we talk through the strategy, and we've incurred 300k to enable that. And secondly, you can see our interest income continues to rise, our yields are getting better, and our average cash balances are ahead. Okay, moving on to slide 13. So this is a slightly different representation of numbers than you will have seen before, and I think gives a clearer read, and also obviously ties into some of the strategy presentation pieces which you'll see shortly. So the top box, just to explain the slide first before I tell the story of the numbers, the top box is split into multi-retailer redemption. So that essentially is our in-house product, our Love to Shop vouchers, our FlexiCash card, which can obviously be used in multiple retailers. That's all our in-house product. Single retailer redemption is our third-party products, so our M&S cards, etc., etc. And then we have an other section which includes all the other products and services we bill clients for. So within there would be FMI sales, would be merchandise, account management, software as a service, product and hampers. So just to read the numbers, so you can see there, multi-retailer redemption is well ahead on prior year, which obviously we're really pleased about, and that drives margin, improves the mix. Single retailer redemption is down in the mix, and that is largely as a consequence of us removing some low margin third-party products which occurred in the prior year. So I think that top box demonstrates, a good positive move in mix of business generating incremental margins. The lower box shows the delivery form, so paper, card and code. And again, the trends are positive. You can see card is increasing in the mix, which is obviously good. Code and virtual would have been greater, but that third-party intermediary business I've talked about was actually some e-code activity. Without that, code would have been ahead as well. So I think that's a sort of nice slide that demonstrates, margin mix is improving. Over to slide 14. So again, a slightly different representation of the numbers from that which you've seen before, and a bit more detail around our core markets this time. So I think you're all used to seeing corporate and consumer splits. Well, I've given a little bit more detail. So again, I'll explain the markets and then tell the story of the numbers. So within the consumer section, we've got our Christmas savings business split out. In terms of demographics, that tends to be sort of C2DE. We've got a consumer other, which is pretty low at the moment, but we think that's a big opportunity and generally has a much wider demographic. So that's a sort of area focus for us. Within our corporate sections, we've split into 4 key markets. So we've got employee benefits and staff rewards. So again, the target market there would generally be HR managers for organisations, so we can be really clear on who we're targeting. And we've got customer incentives. So again, we'd generally be targeting sales and marketing managers within that market. So again, we can have clear defined sort of focused market. And then finally, for completeness, we've got intermediaries, which could potentially ultimately sell into any of the above markets. So in terms of numbers, Christmas Savers is ahead. That's more to do with timing, more to do with us efficiently getting products out to customers faster. Other consumer billings are ahead as well. That's largely direct online business, and we think there's a real opportunity there. Within our corporate areas, some really sort of pleasing results as a consequence of additional online growth and new clients. In particular, customer incentives is up 23.5%. So that's really pleasing. There's a big new client in that market, which is driving a lot of the growth. And as I said earlier, intermediaries down. That tends to be the lower margin channel. So again, that would be in line with the strategy. Okay, over to the balance sheet on slide 15. So only 2 or 3 items to sort of pull out here. Strong balance sheet, no debt. There are lower current assets. That's as a consequence of us carrying less third-party stock because we're selling less third-party product. There is a timing point on cash. So as you all know, we hold a part prepayment trust for our customers. And there's a timing point around moving some cash out of the trust into our own cash. This year that happened just before the end of September. Last year that happened on the 3rd of October. So it's just a sort of timing point there in line with sort of product getting out to customers faster, but no change overall. And then finally, at the bottom, retained earnings have been restated for IFRS 15. So obviously the reduced profit balances off there with lower retained earnings. On to cash. Again, I'll quickly go through these. I think, as you all know, we're very cash generative. This year in this set of results, we've got higher average cash. We've got higher peak cash. So all very positive. And on the cash flow statement, again, that sort of reinforces that. And you can see we continue to pay healthy dividends. So, all hopefully positive. So that's the end of the numbers. Just in terms of guidance then, so hopefully as you can conclude, our underlying trading remains strong. We still see seasonality in the numbers. Approximately 3/4 of the revenue will come in the second half of the year. So that will come through. Our profitability is increasing because of changes in mix, away from lower margin intermediary towards in-house products and towards card and away from paper. There is an impact from IFRS 15, significant on revenue, but limited on profitability. And we have incurred some costs in relation to some research in the first half. So I guess, in summary, from my point of view, pleased to be sitting here after 3 months. I think it's a really, good set of results and, a real sort of solid platform for growth. Back to you, Ian.
Thank you. So really, just to summarise real quickly, as Tim says, the outlook, in our view, for the underlying trading remains unchanged. The order book for the comparative period is ahead. Christmas savings is broadly in line. Christmas 2018, broadly in line with 2017, which is what we talked about back in the middle of the year. But corporate business is expected to be ahead of where it was last year. We got, as I've mentioned, a sound platform on which to build, and with the new team in place, we think we can continue to deliver in the year while we also bring the strategy into place. And the strategy that we're going to talk about, we believe, positions us well for future growth, and very positively so. So we'll move on into the other segment. Just a reminder, I mentioned earlier on that the fact that we're changing business, changing management team, but also changing aspirations, and we think new opportunities, changing marketplace, and what we've been trying to develop is the strategy that will allow us to build on a very strong base, but capitalize on that, take advantage of new opportunities, and set ourselves up for the future. The title slide there talks about Strong roots, green shoots, and a bright future. We've got very strong roots, very good historic base. Our origins are in Christmas savings, working with consumers, but we evolved into this multi-retailer gift voucher space, expanded into the business segment. It's all about evolution and progression, and now we're into electronic gift vouchers and so on. We've gone from sort of an industrial base to almost a fintech type of base. So quite an evolution, but a great history on which to build, and our current position is still a strong one. As I said, and Tim has said, we're pleased with the results we've been able to declare. So our business is profitable. We've got a very loyal customer base. We do have legacy products and processes and indeed infrastructure that we need to address. But there are real opportunities for improvement and an untapped market that we think is very positive. So as we go through the strategy, what you'll see is that we see the bright future built around sort of 4 elements. We want to be much clearer and more precise about what we're about. We want to be able to deliver exceptional service and exceptional experience for our customers. And I should state, customer for us, it means 3 different categories of people. It means consumers that use our product. It means businesses that buy our product for their purposes, and it means retailers who redeem our product. So we think of customer, and we think of 3 different groups of people as we do so. But we want to be fit for future in our processes, in our technology, and indeed in our people, culture, and facilities as well. And we want to address this consumer space, that the new opportunity that we've identified, and we see it all adding up to, as I say, a bright future. So for purposes of today's presentation, we wanted to break it into 3 sort of groupings. We want to take you through a little bit of our thinking, our analysis of the situation. We then want to tell you about our plans, and then talk to you a bit about the outcomes that we see from those plans. So if I start first with the analysis. First off, we took a look at the shape of our business and what we inherited, so to speak. And the historic view of Park Group, you'll have been familiar with thinking about it in 3 business units. You'll have heard talk lots of times about Park Christmas Savings, highstreetvouchers.com, which is our website, which is kind of a one-stop shop for gift cards and vouchers, and then Love to Shop Business. That was our business, direct sales to business arm. And actually the evolution of the company follows that exact path. It was Christmas savings. We then looked at a way we evolved into multi-retailer vouchers, and then we looked at a way to sell that to a broader base and like a non-Christmas savings base, which is why we set up the website. But quickly, the way the website matured, we realized that the bulk of the traffic was from business, so we went to a direct sales to business unit. That's the evolution of the company, and the 3 business units have operated aligned and linked, but quite distinct within the business as well. So the more I've looked at the business and the more I've thought about the business, the more I've said, we really need to think about it and look at it through a different lens. If you're familiar with the author Stephen Covey, he says the main thing is to make the main thing the main thing. When you look at what we do, multi-retailer redemption, whether it's through paper, plastic, or virtual e-codes, whether it's coming through Christmas savings, highstreetvouchers.com, or the business side, multi-retailer redemption is over 84% of our billings. So I think it's easy enough to recognize that for us, the main thing is multi-retailer redemption. So if you then take that lens and think about the market landscape, the UK Gift Card and Vouchers Association estimate the market in the UK to be annually worth about £5.8 billion, right? So what I'm on this slide that you're looking at, which is slide 9 in this set, wanted to give you a sense of the market and where we play and how well we do in the market. So the market's divided into 5 segments. There are 3 of those segments that we would classify as being on the corporate side, 2 of them on the consumer side, if you tie back to Tim's way of segmentation that we discussed earlier. So as you look at the slide, on the right-hand side, those 3 segments are the corporate side, okay? Where the color is dashed, that's our piece of the segment. Where the color is solid, it's the bit the rest of the market has. Top right, up at sort of 1 o'clock on the chart, you see incentives, right? That's a corporate segment. We have about 6.5% share of that segment. Moving around, employee benefits, we have about 5% share of that segment of the market. And then staff rewards, we have 6.6% share as estimated of that market. There isn't a segment called intermediaries because intermediaries sell into those three segments. So if you're trying to tick and tie back to the earlier slide, that there is no segment called intermediaries, but they're absorbed in those three segments. So you can see the three corporate segments, we're solidly playing in all three segments. We want and aspire to do better and have bigger market share, but we're solidly there in each of them. On the consumer side, up at sort of 11 o'clock on your chart there, you can see the segment called Christmas savings, and it's estimated to be worth annually about 300 million pounds. We have the vast majority of that. We are the big player in Christmas savings, and we know that. That's been the history. But if you look at the last segment, which is the non-Christmas savings, other consumer segment, it's worth 2.6 billion, and really we don't play there. We have less than 1% share. So we'll come to why that is and what our customers are telling us about that. But there's clearly an opportunity in there if we can find the right way to tackle that. Other things to note from the market information, just real quickly, no surprise that the format change is still a trend that you can notice. You can see there, and this is just ongoing. If you've been following this market at all, as you have been, you'll know that paper, we're moving away from paper, moving more into plastic and into e-codes and digital. So that's not exactly a new trend, but it continues, and you'll see it you saw it in our numbers, and it's in the market as a whole. The market continues to grow, so 8.7% growth in total gift and card vouchers market in the first half of 2018. You can see also growth in online sales and a significant growth in business-to-business sales. So our corporate side has a great opportunity because that side of the market is growing. And then the two stats there at the bottom, the growth in B2B digital and e-voucher sales, but also the growth in consumer digital and e-voucher sales, both very high. So that's just reflecting the trend away from paper and towards digital and towards e-vouchers and so on. So the summary of our view of the market is that we're not currently addressing a large piece of it. There is that market shift. It's been ongoing. It's not a new one, but it's continuing. It is a growth market. And then the market in general, the world in general, there's a shift away from physical and towards digital, and there's an ever-increasing rate of change. And the point of all these, we need to make sure that our strategy reflects and acknowledges those, and that we're setting ourselves up to be in a position to not just take advantage of them, but grow along with them. As has been mentioned, we did do some consumer research during the year. We did two sets of research. We did one which was customer research with our customers, and one that was research with consumers in general. I'll talk about them both separately. Our customers, if you remember, I said there are three categories. There are the consumers that use the product. They may or may not have bought the product. So some of them will have bought it themselves, but some of them will have it given to them, either gifted to them or as a reward from their employer or so on. So there's the consumer, and then there's the business that buys our product. So a business that wants to reward their employees or incentivize their customers or for whatever purpose. And then there's the retailer that redeems our product in their shops. So we think about the customers as three sets. Talking about the research conducted with our customers initially, basically there remains a very strong appetite for multi-retailer products. Very encouraging, because that's the business we're in. That's our main thing, so that was nice to hear. And indeed, there's a lot of love for Love to Shop. The people that use it like it and find it, a good product. So that's great. And as we've talked about, there's a big market opportunity that's out there. So we were reassured by that, as you might imagine. However, we were also told that there are lots of ways we can improve. One of them is going back to that big market segment that we're missing. We refer to it now as unknowingly undersold. So basically, if you know about Love to Shop and you say, oh, this is great, I'd like to buy it myself, unless you're buying it through Christmas savings, you will find it difficult to buy. That's not our intent, but that is the reality. And that's what customers have been telling us. So it is available. You can do it, but it's not necessarily as easy as customers would like it to be. So absolutely an opportunity for us to improve there. If you think about our products and how they get used, they're associated with uplifting experiences, right? So people saving for Christmas and use it there, that's a nice occasion. People maybe buying them just to give as gifts to people. That, receiving a gift is a nice thing. A business buying them to use for reward and recognition, long service awards, whatever they might be doing, that's quite nice too. Or a business using them as an incentive for new customers to join them. Again, it's nice. It should be uplifting. Customers are telling us, yeah, you're a bit functional. You don't really, we don't feel the joy when we get the gift or passed through to us. So that's an opportunity to improve. Customers are telling us that, yeah, it's great that you've got paper and plastic and now digital, but it's a bit confusing. Your branding is a bit strange, and your where we can use and how we can use your product isn't always very clear. So basically, we can tell that the confusion is suppressing demand. So let's tackle that confusion. Consumers also tell us that it isn't about the number of retailers, it's about the quality of the retailers, and it's really about having a curated set, we call it. So it's not about getting an endless list that's so confusing that I don't know where I should use it. It's about having a list that's crisp and clear, and I know exactly where I can use it, and there are brands and names that I recognize and I want to use. And then lastly, customers, consumers, businesses, retailers across the board say you could be easier to work with. We find it difficult sometimes to integrate, like retailers say it can be difficult to integrate you into our stores. Can you make it easier for us to work with you? So yes, there was a lot of interest and a lot of support and appetite for the product, but also some opportunities for improvement, to state it positively. But that was good. That's why you do research, right? So we did that, and we took a lot from that, and you'll see it reflected in the approach that we're going to take. We did also do the second piece of research that I referenced. So we discussed a new concept with a broad representative sample of the entire population. Okay, so at this stage I'm on slide 16 if you're following in the book. So I must make clear we're switching now from our customers to just a broad representative base of consumers in the United Kingdom. Okay, so that means switch your thinking about C2DE kind of Christmas savings and think full demographic here. So we did 1,200 interviews, weighted, as I say, to be demographically represented. And what we talked to them about was a concept where we could use the component parts that we already have in Park, the savings, the multi-retailer redemption, the digital capabilities, put them all together in a concept that would allow you to save as you go and use it as you want, not be attached to Christmas and not be attached to specific timelines or anything, where you could set your own pots of what you wanted to save for, and you could set your own timing of redemption. But you could still redeem it in different ways for products and experiences in the same ways we have today. So building on the multi-retailer redemption capability, building on our digital and indeed the future digital capabilities that we'll speak to, and building on the savings element, but putting them together differently to appeal in a different way to a broader demographic. And what you'll see there is that of those that we interviewed, so again, the 1,200 interviews that we did, 57% of them rated 8 or higher on the likability scale. So that was good. 46% said that they would try the concept. That 46% translate across to roughly 20 million consumers. Before you all rush away and start upgrading your expectations, we're not saying we're getting 20 million customers anytime soon, but it gives you a sense of the opportunity that's out there. And 78% said that they thought it was a bit different. Now, let me be clear, this is the concept stage. We haven't even got to a prototype of the product, but it gives you a lot of encouragement that there's something out there that we should tap into. And indeed, the researchers that did the work for us said they've seen products launched and very successful with much less favorable results at concept stage. So we were very pleased with that research. So I suppose we've looked at the shape of the business, we've looked at the market, and we've talked to our customers. So when you think about that analysis, well, sort of a summary of what's good and what's not so good. So what's good? Very strong financially, history of profitability, great balance sheet, great cash flows. We're debt-free. I think that's a nice base. Good platform also. Multi-retailer redemption is what we do, and we know it well. We've got a strong industry presence. We've got a flexecash system that we've invested in over the years. It's very, very stable and robust, and we've got great fulfillment capabilities. I'd welcome you up to Valley Road in Birkenhead anytime to see us in operation. Actually, around about now is a good time. Maybe you've just missed peak, but fulfillment is something that we do well. So we've got a very sound platform, and we've got supportive stakeholders, loyal customers, very enthusiastic employees, extensive retailer relationships, and of course, an excellent shareholder register. So lots to be happy about in that respect. What's not so good? Maybe we're not as clear as we could be about what our core business is and what are we really focused on. We've got a complex product set and confused branding. We've got, putting aside hampers and merchandise, we've got something like 450 different variations of our products. Okay, that gets into, it's complex, it's more difficult than it needs to be. So that's what I mean by complex product set. I've mentioned that our consumers are saying we're not the easiest to navigate. The experience of working with us is not as straightforward as they would like it to be. We have legacy practices that mean that we're not as efficient as we could and should be. Some of our operational activity is built on that sort of industrial mindset rather than the more fintech that we've now progressed to be. And so there's opportunities where we could be we will be more effective and more efficient in what we do. And we do face, with the location and the facilities and the legacy situation, we do face challenges attracting talent at times. And then also we've talked about the untapped potential. So as you would expect, we've tried to reflect those things and those opportunities, but also those challenges in our strategy. So if I move forward to talk about the 4 pillars on which we've built our strategy, first is that the point I made about clarity. The second is experience, the customer experience and how people interact with us. The third is productivity, the whole being more efficient and more effective. And the fourth is appeal, trying to tap into that untapped market. So let me take you through each of them in a little bit more detail, if that's okay. So pillar 1, we want our first priority to be that we would focus squarely on the multi-retailer redemption product. So the main thing, and make sure it is recognized as being such, and when I say focus on it, it's as much internal as it is external, that we focus on it, understand it, and make sure we deliver on it. And as an immediate action in that respect, we want to make sure that our business is indeed focused on that. And so because of the history and the evolution of the business, you've got your hamper production side of the business very much intertwined with our multi-retailer redemption side of the business. And that's just history, it's just the way we've evolved. But we need to disentangle those two. So as a first order of business, we've set in motion the process of basically separating the two and making hamper production like a business within the business. It is a very small piece of our revenues and billings at this stage. It's still something that we've got a lot of history in. So we're going to separate it and keep it and give it a chance to thrive while we disentangle it from the multi-retailer redemption piece and allow that one to really focus on what it needs to do there. We'll also do some other things around simplifying our product set, having a much more disciplined approach to new product development. We will structure the business around this approach rather than the way it has been structured historically. And then we will redefine and rationalize our brand. Our brand, as I mentioned, is a bit confusing at times, and we need to sort that out. The ultimate impact of all this is that if we do keep the main thing as the main thing, we will ensure that we can align all our efforts and make sure everything that is working in concert, if you like, and that we are focused in our delivery and our execution of our plans. So first order of business is clarity. Second, experience. We want to make sure that we are easier to work with for our different customers. And again, I keep stressing there are 3 different sort of ways of looking at customers. But we want to make sure that we are easier to work with for our customers. Our immediate action in this respect is that we want to make our current product set fully digitally enabled. So we'll move to MasterCard Digital Enablement Services, MDES, but we will move in that direction and integrate our product into contactless and mobile wallet for consumers. As we go forward, we'll be talking about making sure that digital is the first priority and that paper and plastic support it rather than that we treat them, the three separately as might have been historic. We want to make sure that our customer experiences are what we would want and what customers would want. And we want to invest in our strategy with retailers to make sure that we've got a holistic view of how we interact with retailers. And as they have told us in the research, we should make sure that the experience for them is straightforward and easy, that we make it very easy for them to integrate us into their stores if they have them or into their online offerings if that's what they're doing. Ultimately, what we want to do is provide the best-in-class customer experiences and data journeys, which will allow, we would hope, greater product take-up and enhance the value both for our consumers and also for our retailers. So that's the second pillar, which is experience. And then third one, we want to be more effective and efficient in what we do. Our first immediate action is that we are going to move the multi-retailer redemption side of the business to fit for future facilities, and we're moving away from Valley Road over the water into Liverpool city centre. As we move forward, we'll do other things. We'll be able to be more automated in some of the uses of our technology that we'll talk about in a moment. We're going to invest more in our people and make sure we have the right skills and capabilities as we go forward, and prioritising digital and card solutions over paper as we move along, which is in line with the trend and in line with what consumers are telling us. If we can improve the culture of collaboration, enhance the workforce, enhance our talent pool by being in the city centre of Liverpool, it'll result in increased capability but also increased productivity, which will translate back into greater performance long term. So productivity is the third pillar. And then our last, the fourth pillar is that we want to increase our appeal and broaden our appeal to drive growth. So I've talked about this. We want to launch a product that would be targeted at that currently untapped market, which has a broader demographic. By making better use of data as we go forward, we can enhance our proposition, enhance our marketing, and we also want to enhance our distribution model. Our distribution model has historically been based very significantly around an agent model. Agent models are sort of moving along, and then fewer and fewer agents are signing up, and we're seeing that in other industries as well. No harm in that, but we could use the digital capability that we have in a different way, in a better way, that would allow us to enhance our productivity. But there are also perhaps other physical distribution opportunities that we've never tapped into that might be worth exploring as well. So we're going to be focusing on our distribution model, making full use of the digital capabilities that we have and that we will get over time, but also looking at other physical opportunities as well, while at the same time making sure that the agency model as it exists is still fit for purpose and is effective, because it does contribute very significantly to our business. Ultimately, we want to make sure that we build on the strengths that we have, but make them applicable to the market that we see now and the trends as they go forward, which means that we should be able to reach new and bigger markets if we do things correctly. So those are our four pillars of our strategy. We believe it sets us up well. There's also already some things that we're doing that are foundational to those strategies, and Steve will talk a bit about those.
Thanks, Ian. So Ian's defined the strategy and the opportunity, and I'll take you through our delivery capability and approach. Fundamentally, we're creating an organisation that's anchored on digital, not just for product and technology, but because it's as a way of thinking, working and doing business. And not just because it's a smarter, more efficient way to operate, but because it makes us a better place to work and we can attract and retain that better talent. Also, it's what the market and our customers say they want. You'll have seen on the slide 10, the market trend slide, at the first half of this year saw digital overtake paper for the first time. And that's a trend that's just going to carry on continuing. We really do see this convergence of physical and digital. So what do we have already underway? We've got the customer research piece. We always put the voice of customer at the heart of what we do. We've looked at people. We've assembled a very strong executive team, continue to recruit the best talent with a focus on technology and innovation. And obviously our ability to attract and retain that talent is going to be significantly enhanced by the move to the city centre location. We've got some excellent universities and an excellent innovative pool of like-minded fintech companies which are in the Liverpool area. So we are already going to be playing in that space. We've got a great culture, and we're building on that strong culture to drive a high-performing, great place to work. As I say, we are anchoring that in digital as a concept and as a reality. So looking then at a technology roadmap, what have we done? Well, we're in the API economy. That's absolutely critical to us, the way we operate and the way we'll operate going forward. That's talking about consuming and distributing on a digital basis. So from that perspective, we've looked at API optimization, which provides real-time connectivity for digital transactions. We've looked at the in-app digital realization, which gives us a conversion capability for consumers actually in the app. We've done real-time load and top-up for instant multi-channel reload functionality, and e-code provision, working with our external e-code providers and creating and generating our own e-codes, so we get immediate e-code purchase fulfillment. This is all focused on the customer experience. It gives that immediacy, instant gratification. It's a prerequisite for the modern way of interacting, the modern way that customers want to interact. And it's back to this concept of being less functional and spreading the joy. From a business perspective, we've looked at self-serve opportunities. We've created a self-serve digital concept, a self-administered portal solution that reduces back office overheads for them, enables them to reduce their overheads, and actually gives them some broader opportunities to integrate further with us on a native digital capability. And finally, perhaps most significantly of all, we've looked at the Love to Shop app. So that's an app which brings together all of our Love to Shop capability, the main thing being the main thing in the Love to Shop app. Full mobile access to the entire Love to Shop product range, and an ability to interact and change into codes or virtual card. And the virtual MasterCard, which we were first to market with, provides curated or open loop MasterCard payment access, so taking advantage of those industry standard rails. So it's a full range of digital channels which we're exploiting. So let me reiterate, these are things that we've already done this year. So looking ahead at what we're going to do. So this is looking over the next year and medium term, so sort of 1 to 2 years. First of all, digital mobile payment enablement. Ian mentioned this already, the MDES process. So we're looking at Apple Pay, Android Pay. We are extending the mobile experience, providing contactless mobile wallet capability. We're looking at a microservice core ERP or enterprise resource planning solution from an infrastructure perspective. It gives us a standardized, enhanced infrastructure. It gives us a significant enhancement to our current infrastructure, and taken together with some of our app-enabled web portal electronic point of sale or EPOS functionality, it gives us a much better way to integrate with retailers and to integrate them into our current existing architecture. We're looking at analytics as a service. It provides a relationship value add and a potential new revenue stream. We are taking this value on demand concept, this instant gratification, to the next level, so this omni-channel access concept. And personalization is a huge thing, and the technology is really facilitating that. So our personalization within the corporate space has already become one of our biggest and most popular products. We're moving that into the consumer space, and it provides, again, a much enhanced customer experience. And we're working with some significant technology partners externally as well. So BlueVen, we have a project underway at the moment to deliver a new marketing communication suite. That's being delivered next year. Provides the next generation in terms of customer acquisition, customer retention and analytics. Again, it all feeds back into our data model. We are building a very cutting edge data lake, data warehouse infrastructure that will support our analytics capability. And then finally, we're looking at multi-cloud deployment. It gives us scalability and resilience in our core infrastructure architecture and our application layer. It facilitates our move to new premises, because clearly we're not moving physical hardware around. And it gives us an ability to, again, increase our digital optimization. So taken together, this delivers a new product, new capability and new infrastructure and a way of working. And in particular, it changes our technology function from an inward-focused IT to outward-looking product and customer-centric software engineers. We're already delivering platform and software as a service, about to go live with analytics as a service. And despite that having a rather unfortunate acronym, it's a really transformative area for the industry. So what could this look like? Delivered to the palm of your hand. It's a fully mobile, contactless or wearable and biometric enabled platform with which you can save with us, and not just for Christmas, and spend with us across every channel. And looking a little further ahead, we're considering blockchain. We're looking at digital supply and transaction verification utilising blockchain, looking at AI for chatbot and customer experience gratification, machine learning for smart data extraction, which again amplifies our analytics capability. And we're looking at layering capability of fog and dew computing to empower our always-on Internet of Things so that any device with our app on board can be used anywhere, whether it's connected or not. So in summary, a proposition anchored on digital, an organisation anchored on digital, a technology roadmap delivering new product, new capability, new infrastructure and a way of working, a technology function which changes from inward-focused IT to outward-looking product and customer-centric software engineers, a technology future which embraces all the relevant new technologies that we have available to us, and customers that are able to save with us, not just for Christmas, and then spend with us across every channel. But I'm sure you wouldn't expect me to finish a technology summary with at least one Steve Jobs reference. He used to say, you start with the customer experience and work back to the technology. That's exactly the approach we're taking. We're spreading the joy of our products enabled by the technology. So sustainable green shoots and a very bright digital future.
Final section, just some of our initial thinking on the outcomes of everything you've heard this morning. So as a recap, 4 pillars. Clarity, where we're going to separate out our multi-retail redemption proposition and convert our hamper business into a business within business. Experience, where we're going to be easy to work with, particularly within the technology area. Productivity, where we're going to be more efficient and effective, and the immediate action is moving to fit for the future offices. And appeal, where we're going to launch a new product to broaden our demand. So I guess the next stage really is to develop some business cases to evaluate everything. Some of those are clearly going to be pretty tangible and easy to calculate. You know, we know how much a new office is going to be in Liverpool. Some of them are going to be less specific and less sort of tangible. Our branding review will hopefully give us a better set of refined brands, but it's less clear how much additional market share increase we can attribute to that. The next slide is some of the thoughts on the initial sort of thinking around that. So in terms of number 1, separating out our hamper business. Hampers actually have quite a minimal impact to our business. They're about 2% of our revenue and make a small net margin. So this initiative is not really about significant financial impact out of that hamper business. It's all about focus. So by separating the businesses, we'll get greater focus within the hamper production side and also much greater focus within our multi-retailer redemption part of the business. Within technology, we're investing in 2 key areas within an ERP and within cloud technology. We're confident both those initiatives will have a payback inside 3 years and will reduce medium-term operating expenses. Head office location, so we're currently in a very old industrial site. Teams are in separate offices and actually separate buildings. If you look at all the surveys of moving to new open plan environments, which obviously generate much better collaborative working, then the surveys sort of tell you can expect to achieve between a 10 and 20% productivity improvement. We need 4% productivity improvement to sort of break even on the extra rental costs. So we're confident that move will not only improve working and collaboration, but it will actually reduce net operating costs going forward. And finally, out of the 4 specific pillars, we're going to launch a new product which is in a separate market we currently don't attract customers from. So clearly that will be incremental customers and incremental profits. 2 main areas at the bottom of that slide, market share increase. So of all the various other initiatives that you've heard about this morning, we believe that giving better brands, a better product and a better technology route to customer will generate an underlying market share increases and incremental profits. And secondly, within cost rationalisation, a number of initiatives we've talked about today, reduce costs, particularly the move in mix away from paper to card. And again, we believe that will continue to reduce costs going forward. So I guess summary and just an indication of timings on this sort of final slide. So we're going to have a targeted set of products, and we're going to separate out our hamper business. We expect to do that in the first part of 2019. We're going to become a digital-first business with investments in two main projects: ERP, which we're going to deliver by 2020, and cloud deployment, which we're going to deliver over the next couple of years. Also, I think before then, we're going to ensure we have MasterCard digital enablement. Within our work environment, we're going to move to new offices by the middle of 2019, and then we'll start to see the productivity improvements that we'll see will reduce operating costs. And finally, launching a new product we expect to do by the end of 2019. The final slide then is an investment summary, which I'll leave you to read and hand back to Ian.
Thanks, Tim. So in summary, hopefully you can see we've got a strategic plan that we think builds for the future, sets us up well. We got a new vision, bold, and departing from the old mindset and separating out and being more focused on our main event, shall we say, the multi-retailer redemption, putting it squarely as the center of what we do. We've strengthened our leadership team to match the ambitions that we have, but we also have an amazing group of people already working on this and just chomping at the bit to get moving further into it. An incredible platform, great financially sound as we talked about, but a loyal base of customers that we want to build on, and some wonderful retail partners, and as I said, wonderful employees to deliver on this. So with this plan, we're intended to clarify our brand, make our product set more focused. We want to optimize ourselves operationally and breed a culture of collaboration that will mean that we'll be more efficient and drive greater productivity. Better and seamless customer journeys should make it easier for customers to use our products, and then for partners to use our products, and for us then to be able to enhance our position in the market and grow share as a result of that, and genuinely realize our opportunity here. So we think that this is the right plan for the business as we go forward. We think it builds on the great, strong base that we were given. We think there are already great signs within what's going on, but there's definitely a bright future. So strong roots, green shoots, and a bright future. Be happy to take any questions as you might have them.
Going back to slide 9, could you just say how much of that market would you estimate? It's probably very difficult. But how much of those markets where you have the smaller shares are directly addressable by the main thing? And then presumably when you talk about the new product, that's about being able to address an even larger part of the market.
Yeah. The main thing is absolutely what's allowing us to address. You're talking about the consumers, the corporate side.
Yes.
Yeah.
So, for example, if you've got a 6% share of incentives,
yeah.
Is it the case that you could address the whole of that incentive market using the multi-redemption product, or you actually need new products to be able to address the whole market?
Yeah, I think it's the former, not the latter. So what we have today addresses what the market, what that segment wants. You're always in a position where you want to enhance that, and trends change, and an employer might decide, oh, my employee benefits package, I wanted to do something differently. So we'll always be adapting. But at the moment, the products we have address needs there, but we're always enhancing them. But we could continue to penetrate those segments without the new product development, which I think is your question, without the new product that we're talking about. So the new product, what we're trying to do is find a means to use our capabilities that we already have and build on those, but to attract a different demographic and a different use case and need case. So there are consumers out there who clearly say, well, I'm not going to get into this Christmas savings thing. Okay, that's fine, but how can we provide something that would meet your needs? Because we know you have needs in terms of wanting to save up for different life events. So we're trying to take what we have, put it together slightly differently to attract a different audience and a different demographic. There may well prove to be a benefit into the corporate side of that construct, and then that'll be part of our thinking and our evolution. But we're starting off saying, look at the consumer side, but may well enhance our opportunities on the corporate side in due course. We'll know in future.
So just following on from that point, on the new product then, you envisaging for the different demographic that presumably they would want to be paid interest for the service you're offering?
Yeah, so we haven't touched on that yet. We are not a bank. And we do not have a banking license. We have e-money license, obviously, but not. So, yeah, I mean, look, we're talking about a concept that has been tested and been favorably received. We still have to develop the prototype and work on that and then test that as well. So we're a while away from it, but we recognize that there's the opportunity and we want to declare that's what we want to go after. So, further answers for those sort of questions in due course.
Thank you very much. Thanks, Ian.
See you again.
In your 4 pillars, I mean, given that the industry suffers from, I would say, perceptions and misplaced biases, I would have expected one of your 5 pillars, if it be, to talk about branding, positioning, and making park as a reliable place to park your cash.
Yeah.
And you didn't, not a single word on that line was mentioned. Can you throw some light?
Yeah, well, we did mention confused branding and the need to redefine our branding. So that's absolutely something that we want to do. I didn't specifically address any sort of lack of trust issues. That will be part of our thinking around brand and branding. As a separate pillar, I suppose we didn't put it in as a separate pillar. It's part of our thinking. We would believe that we need to have a very good story and tell the story well. So make sure customers understand there's a great product and a great capability, and then make sure they understand what that capability is and how they can use it. Sort of wrapped into that is the trust that they would have in us. So we didn't call it out as a specific pillar, but it is part of what we're thinking about. And I suppose it would be laced into the make it easier to work with us, because that's where the the branding part is going to be, but also the focus, making clear what we're about and how we're doing things. So branding plays into that too. So it's in there, but yes, we didn't call it out specifically, but rest assured, we want to make sure people feel that we are trustworthy. We know we are. We could emphasize that more, I suppose, is your point, and it'll be part of our discussion around brand.
I just wanted to understand what's going to happen to the agents, because obviously in tangential industries there's been real problems with agents and how they've developed as the new propositions have come on board. And I didn't really understand from this what the role what changes agents will see and how they're going to react to it.
Yeah. So currently we do have agents, and we will continue to have agents. We're not changing that. What we want to do is make it easier for agents to work with us, first of all. So where agents want to use the digital capabilities, make it more straightforward. We've already enhanced the experience for agents anyway, so making it more straightforward to work with us. We do want to make sure that the digital capability that we have can be used in a way that enhances our reach. So rather than forcing agents to act in a different way, no, that's fine. We just enhance what they can do today. But actually, we can think of using our digital in a different way that will enhance our distribution. So you'll see lots of member get a member type of initiatives, and we've done bits of that in the past. But how can we use the digital capabilities that we have today, but also what Steve is building for us to create that distribution capability in a way that we don't have today? So it'll augment what we have, because the agent model has been declining. We know that, and that's fine. We'll use it as it is and to the best we can, but we'll have an alternative as well in terms of our physical and digital distribution, was what I was trying to articulate.
One of the aspects of saving for Christmas was this idea that the money was secure and it was not accessible. The moment you put it on someone's phone, it becomes perhaps a little bit more accessible. I just wonder if it changes the nature of the relationship with your clients.
Yeah. So Steve will probably want to talk to that as well. But I would say, obviously, it's about how you set it up. So it's not necessarily that you can make it in a way that it's not as accessible as immediately, so that you maintain the integrity of the product, but just use the digital capability to make it easier to use it in other ways. Does it? So maybe you express it better. Yeah.
So we have a Park Christmas Savings app. and it's there on people's phones already. It has been for a while, but it doesn't mean that you can spend it like in that way. It means that you use that. It's a tool to manage your Christmas savings process. People still define what they are saving for, and they set targets. And it's a good way for them to effectively self-serve that process, and they can use it to increment or decrement as they want and move between different pots, and they can redeem into different savings buckets. But at the end of the day, they're still part of a fixed savings process, a prepaid process. If we're looking at how we might manage a future product, it would be again on the basis of having defined targets and pots, and potentially micro pots that you would again put into a management process. But you will be able to draw down on it at fixed points, so you'd still have that control. It would still be a prudent budgeting tool, which we're very good at. You hit the nail on the head. It's one of the things that's strengthens. It's a real strength that we have, and we want to try and build on that. But it would just make it more flexible, so that it's not just all about Christmas. It's about other things that people might need to budget for.
Perhaps I should also make it clear that we're not talking about this. There's this segment that we're not playing in sufficiently. We're not saying that we're going to have one product that fits all. We can have different products. So the Christmas savings, we will continue to, that's a very valuable market for us. It's a great one, and we're very proud of it, and we want to make sure we continue to provide that option and that service. We can build on what we have today, but have a product that matches needs the way Steve described for that other population. It doesn't mean replacing everybody with the same product. It could be a different, and most likely will be a different one. Well, thank you all for coming this morning. We are pleased with our results for the half year. We're excited about the opportunities that the plan entails. A lot to deliver. It's quite transformative, really, in terms of what we're trying to achieve. So we've got a lot of work to do, got a lot more to report back to you on. So we will be keeping you informed in due course, and we'll talk to you more specifically as we can. So again, thank you very much for being here this morning. Appreciate your time.